Well, good morning. My name is Rick Deluge, and I'm a member of the Committee on Financial Matters for the UW Retirement Association. Thank you all for joining us this morning. I'd like to introduce our speaker today, Betty Custer. Betty Harris Custer is the founder and managing partner of Custer Financial, Custer Plum Financial now. Betty boasts nearly 50 years of financial planning experience as a member of senior management for several national firms before founding her own firm in 1981. And then she joined Lincoln Financial Advisors in 1984 as one of its first female regional managers. She is a lifetime member of the Resource Group, an invitation-only nationwide network of the top 200 planners within Lincoln Financial Advisors. And she holds the title certification of a certified financial planner and chartered retirement planning counselor. She has a long resume here. I'm not going to read all of these things, but I did want you to know that she has chaired the Overture Center for the Arts Foundation Board, chair of the Lucier Community Education Center, Chasen Museum of Arts Advisory Council, and I believe you're on the Overture Board of Directors.
I am. I'm the president right now.
Right. Mm-hmm. So she's very occupied with many community activities at the present time. She has received the 2016 Lifetime Achievement Award in Business Magazine, Women of Industry. She has received the YWCA Women of Distinction Award in 2010, and many other awards and recognition. So today, Betty's going to talk to us a little bit about how do we prepare for a long retirement in these volatile stock market times that we have. So without any further ado, I'll let Betty Custer make her presentation. I think what we'll do is have the presentation and then probably take a break and come back for questions after that.
Great. Thanks, Rick. And thank you all for being here. I see a number of familiar faces in the audience, as well as some new ones. Let me see. Is anything moving? I guess I'll just go that way. So I want to talk to you about a couple important things. You heard from Rick. I've been in the business it's been my only career, really. I'm a graduate of the University of Wisconsin, the art department, which doesn't have much to do with what I'm doing now. I was actually working my way through college. I'm the daughter of a lifelong educator, teacher, and coach here in the Madison area. Bob, he was best known as Boomer Harris, and while I desperately, much as I now love this city, and it would take a lot to drag me out of here, much as I feel that way now, there was a time when I graduated from high school having lived my entire life in Madison, Wisconsin, and not having traveled very much either, because our family didn't travel. Our idea of a vacation was packing up the car, looking like we were going cross country, and driving the 25 miles to Cambridge, Wisconsin, and renting a cottage on Lake Ripley. So I had that wanderlust that a lot of 18-year-olds have, and I really did want to go somewhere else to college. And I was recruited pretty heavily by one college I'd interviewed with, Smith, and I don't even know why I picked that. I think just the exoticness of a small college out in Massachusetts, happened to be a women's college as well, but that hadn't really been a key point for me. And by the time I got back from what they were offering for scholarship, what they were leaving behind was still in the thousands. And at that time, it cost about $300 to go down the street to our favorite campus. And my dad said, quite honestly, no disservice to him. He'd been the sole breadwinner in our family. We don't have that difference. So I ended up going here. By my sophomore year, I wanted to at least live away from home. And my dad had a great answer for that too. You've got a perfectly good bedroom in this house, so that's on you. And so I decided to work full-time and go to school full-time which led to me becoming sick and dropping out of school. But I did work full-time for a year, and the job I got was actually from one of my dad's former basketball players. And I was working in a financial services office and really became enamored with that. And so when I decided a year later to go back and finish my degree, they asked if I would stay on, and I did. And when I graduated, they asked if I'd become their office manager, and I did. And then they suggested that I go into becoming a financial planner myself, and I did. So everything just kind of fell into place, all from a young woman who kind of was seeking something different than what she'd always known. So I'm very grateful for the opportunities the financial planning industry has provided me. I see a few client faces in the audience as well, so it's nice to see you here, and I've been very blessed, in my opinion, by being part of this profession. I think it's a marvelous profession. I think helping people with their financial well-being is one of the great teaching opportunities. And so I was kind of following in my dad's footsteps and my older sister's footsteps in that regard. The reason you're going to see Lincoln Financial Group up on the slides is not because we're trying to promote a product or a company. We're a very heavily regulated profession, and everything I share with more than one person is called marketing and has to be pre-approved. And therefore, there's a bunch of disclosures at the end of the presentation, the handouts you have, and also the broker-dealer with whom I'm affiliated has to be fully disclosed to you all during the presentation. But believe me, we're going to be talking very generically. We're not going to be talking about specific products at all. When Rick said that he thought that what you might be the most interested in would be how to make sure you have income for the whole of your lives. After all, isn't that what retirement is all supposed to be all about? I'm probably a similar age to a number of you. I'm 71, and I'm still working. But as Rick also mentioned, Custer Financial Services now is Custer Plum Financial Services, because in order to make sure my clients were protected if something either unexpected happened to me or in the event that I do, in fact, retire at some point, I needed to have a successor. And Nate Plum of the Plum family, also in investment planning here in the community for 35 years, is my successor. So one of the things that I want to talk about, because being in this profession as I have for almost 50 years, I have seen something in the last couple of years that I think is unique. And it doesn't really come under the category we're seeing on the screen or in your handout of a market bubble. It certainly comes under the category of increased volatility. Volatility is the name of the game in the stock market now, as you all are experiencing when you turn on the TV or the radio. And of course, when you turn on the TV or the radio, what do they tell you every day? They tell you what happened to the Dow, which is absurd. The Dow is 30 stocks. They shouldn't be telling you what happened to the Dow. They should be telling you what happened to the S&P 500, which at least is a good barometer of the US market. And if they really wanted to be making sure you understood what had happened that day, they might also tell you what happened in the NASDAQ, which would be the smaller and mid-sized companies. And they might also even tell you what happened in some of the international sectors as well. But that people change very slowly in some regards. Nonetheless, when you do hear that the Dow has gone down 100 points, 150 points, 200 points, you're thinking, oh my goodness, what did that do to my portfolio? And then if you're really concerned about it, usually in the middle of the evening, you'll be able to log on. You probably all have, at least many of you probably have electronic access to your accounts, and you can see what actually happened to your funds that day. First off, I'd encourage you not to do that on a daily basis. That is, these kinds of markets could drive a person crazy. I have to do that. I have to do that for those of you in this room who are my clients and all my clients who aren't in this room. And Your planners hopefully are doing the same for you, but you don't need to be doing that. And it just simply causes you more angst than I think is wise or healthy for a good retirement. Obviously, you want to be looking at your accounts on a sporadic basis, and you certainly want to be meeting with your advisor no less than once a year, preferably a little more often than that in these kinds of markets. But let's talk a little bit about some past times that we've had market bubbles. What exactly is a market bubble? You know, it's a time when the speculative investors have pretty much taken over the path of the investment world. They are, the formerly risk-averse people are watching almost everybody else getting into a market, and so they finally jump into, even if they've been sitting on the sidelines. I will tell you that almost every financial planner who's been working in the business for a long enough period of time will recognize the signs when a couple of their clients who have been extremely risk-averse call up and say, maybe we should get some money into the market. We take that as a signal that maybe it's about ready to fall. Because oftentimes when some clients who have not had a well-diversified portfolio and have really not wanted to be in equities for a very large portion of their money, when they finally are hearing at the book club or the cocktail party or church or some other gathering such as this, how well all their friends are doing, and they realize that they've been doing far less well because they've been very conservative, they just assume that this is being quite foolish and they have to jump in. So many times when you start seeing some of those risk-averse people starting to jump into the market, it's a pretty good signal that maybe we're near the end of that market. You all may know that we right now, in terms of time, we're in the longest bull market ever. This bull market started on March 9th, 2009. That was when they officially declared an end to the Great Recession. Now, do you know how, you probably do, know how a recession is either declared as starting or ending. If a recession starts when we've had 6 consecutive months of backward movement in the gross national product, 6 consecutive months. So you all may remember that late last year when the markets were pretty volatile and were by and large going more like this than like this, there was thought, oh, we're headed towards a recession. We hadn't even had 1 month of negative GNP at that point in time. And we would have needed 6 consecutive months before we would be called officially in a recession. That's why many times, and you're going to see a chart in a few slides, many times by the time a recession is officially declared, the market has already gone down. And many times the market actually starts going up once they've officially declared the recession, because what's been happening in that 6 months moving towards the official declaration, the Federal Reserve, at least the Federal Reserve of the last 3 decades, will jump in with its policy of lowering interest rates, trying to make sure that the recession will have less impact, be less severe, and end more quickly. And so last year, when all this was happening, and some in the media even were saying, are we headed towards a recession? All of us were saying, we have no signs of a recession on the horizon. In fact, the earliest we expect a recession is 2020. So market bubbles, though, come from that time of just this euphoria, you know, when it seems as if everybody who wants to be making money could be making money, and many times people jump into them. Some of these cycles we've all lived through. Within the last 25 years, we've had the stock market crash of 1987. We had the dot-com bubble of 2002 to 2002, and the financial crisis, which now we're calling the Great Recession of 2008 and 9. It started near the tail end of 2007. So those are the things we've been talking about. You see these beautiful tulips. We actually have a few here in Madison now. It's finally warmed up enough that we have tulips, although not quite as many as we would have liked. Did you all remember hearing about tulip mania? It actually took place in the 1630s. It was such a robust market in Holland at that time that there was all this speculation built on selling assets to raise cash to invest in tulip bulbs. Most of us would not think of tulip bulbs as a class of asset and investment, but it was at that point in time. After the prices crashed, however, there was a rampant amount of losses that impacted everyone all the way up to the royalty, and something from which the Dutch market did not recover for a long time. There was quite a depression. So that was a true market bubble. The other one that some of us will remember, most of us haven't lived through, but most of us remember hearing about, was of course the Roaring '20s. Wild speculation in just about every area of the market. Real estate being one of the areas, but the stock market moving to all-time highs. Investors, both large and small, taking far more risk than they were really personally comfortable with. And eventually, there was one method of a lot of people, including even just the typical average investor, buying into investments was to buy on margin. And you've all heard that one of the reasons people feel that the stock market crashed is because people were buying on margin. They didn't have that much of their own dollars at risk, so they were taking this inordinate amount of risk, and then when the market crashed, then we had serious problems. 1987, anybody remember that one? I see one guy over here who biked over from campus after the 550-some point drop on that Monday, because he was still living just outside the Highlands, and my office at that time was in Pyar Square, and he was just going to stop by and find out if I had anything to say about what had happened that day. Do you remember that, Bill? But anyway, 1987 was another time of rampant expansion. The Dow Jones, and that time it made a little more sense to be watching the Dow. The S&P wasn't as widely tracked. The Dow Jones rose 44% between August of 1986 and August of 1987. 1 year's gain of 44%. In mid-October of 1987, stock prices began sinking for a variety of concerns. To be honest, I don't even remember specifically what was drawing them down at that time. I think a lot of it was that people had just thought, this has gone too far, this has been too much. But what I will remember, what most people will remember, will be Black Monday. And I actually remember the Friday before. Because the Friday before, I was sitting in my office over at Pyar Square, and the Dow went down over 100 points for the first time ever in history. So we all went into the weekend extremely nervous about what that was going to mean. And one of the things you could track and watch over that weekend then was how much money was being pulled out of mutual funds. Because obviously, while the market wasn't open, the sell orders were flooding into those funds. And so we knew, because of that volume of sell orders that were going in over the weekend, that Monday was going to begin down. I remember I was supposed to go to lunch that day with a couple of older gentlemen who were with Lincoln, who were actually later decided they were going to join my firm to retire. But at that time, they were not quite as attuned to the market as I was. And when I got to the office and saw the market plummeting, and I called them and said, well, I can't come. I have to be here to be monitoring things and taking calls as they would come. And they said, why? And I said, because the Dow was going to be down over 500 points, and it was. It ended up the day down over 500 points. At one point in that day, I actually made a call to Dave Zwiefel. Some of you may remember his name. He's a editor emeritus now at the Capital Times, and but at that point was the head editor for the Capital Times, and he's been a friend. We've served on some nonprofit boards together for a long time. And I called him when a client had called me, or actually an adult child of a client called me, and wanted to know if they should go down and take their mother's money out of the bank and put it in a shoebox in the closet. And that's when I realized how severe the panic that the media was creating by this event was being perceived by the general public. That those who had lived it, as this elderly person had, those who had lived through the great crash were having visions of that happening. And remember, what followed the great crash were the banks collapsing. And so many people were having visions that even their very safe and secure money sitting in the bank was going to be at risk because of what was happening that very day. And it showed me the power of the media to either inflate these kinds of volatile reactions or to calm them. And I knew that Dave would do his best to try to calm them. And I got to him before the deadline that day, and I think it was even that day then that he came out with a column quoting me and saying that I had called concerned about this and that people had to realize that this had absolutely nothing to do with anything at all akin to the Great Depression and the Great Stock Market crash of '29. But those kinds of things are very scary. And now when you think about it, 100 points on the Dow, how many 100-point swings on the Dow do we have every single year? Now, as you remember, 100 points on the Dow is nowhere, is percentage-wise, anywhere close to what it was in 1987. In 1987, that was a much bigger fall. But we're so used to that volatility now that we've redefined our definition of what volatile really means. One of the things I wanted to talk about, you probably, some of you in this room, will remember the name John Bogle. Anybody? I see heads shaking, hands raised. John Bogle is credited with being the founder of index funds. Wonderful instruments, to be honest. I happen to be in favor of active management. I don't believe in indexing as a basic strategy. I think there are some good index funds, and they do play a role in some of our clients' portfolios, but I do not believe in indexing as a basic strategy, with one caveat. If there is an individual or a family that really feels they have very little knowledge base and very little desire to have a knowledge base about the market, and they're not working with a professional who could give them advice, indexing is a far better alternative than sitting in cash or opting for something that maybe would otherwise suit their needs, treasury bonds or something that they felt they understood, backed by the government, safe as safe can be. Well, in last December, John Bogle came out and said, you know, this vehicle I created, and I should say one other thing, because a good friend of mine and a wonderful philanthropist here in town, Tom Terry, was working at the Capital Funds back in the 60s and 70s. That's the Capital Funds is the parent company for the American funds. Some of you hold those, I'm sure, in your portfolio. A very stable, great fund family. And Tom actually was asked to create the first indexed mutual fund for the American funds. But it was one index fund, and it never really reached the reputation or the size of what happened with John Bogle's invention, because John was at Vanguard. And Vanguard became known as the home of index funds. That's primarily their main form of investment. So John Bogle came out in December and said, I'm really pleased with what I helped create. But he said, there's an issue. And the issue is that index funds are leading to more market volatility. And it's very simple to understand that if you think about the concept. Let's say we had volatility like we were having mostly in the fourth quarter of last year. We had some all year long, but fourth quarter was really extreme. December, most extreme of all. And let's say a manager of a mutual fund, let's just pick someone like Tom Plum of the Plum Funds, or let's pick someone like Will Danoff of Fidelity, Contrafund, and New Insights. One of these managers sees redemptions coming into his fund, in part because people are scared. And they say, I got to get out of the market now before it collapses, like before it crashes. I got to get out. In part because it's December and people have holiday bills and property taxes and charitable giving they want to do. And they were going to take a redemption anyway, but now they're maybe going to take it a week earlier or something just because of this volatility. So you've got these redemptions coming in. What does Tom Plum do? Or what does Will Danoff do? They look at their roster of stocks and they say, Tom will say, for example, no, I don't want to sell Exact Sciences. I think it's on the upswing. Don't want to do that. But maybe this fund over here, this stock over here, maybe I'll get out of that one and this one and that one. And Will Danoff will do the same. He'll say, maybe I don't, in spite of the troubles right now, I don't want to sell Facebook. I still play tennis with Mark Zuckerberg. Plus, I still think it's going to keep going. But, and so he'll pick a couple different things that he thinks he's going to sell. What does an index person do? Push a button. They sell the whole index. So you can imagine why that adds more volatility to the market in totality. So it was interesting to me that, that John Bogle made this statement. And when he made the statement in December, I'm sure some people knew, but I didn't, that he was nearing the end of his life, and he died in January. And I think that was something he just wanted said about this legacy he was leaving. And so what I'm telling you is not to blame index funds or get out of them hoping that they'll shrink and the volatility will therefore shrink, but be aware of that volatility will be something that will be forever a part of this market, in part because of the preponderance of index funds. So that was Black Monday. And you may recall that one of the results of that is they wanted to stop managers and financial planners and firms like Merrill Lynch from also being able to push a button and sell bucket loads of stocks with the ease that our computer kind of methodology now allows us to have. And so that was one of the results of that particular day. The dot-com bubble was again, something where we got awfully excited about what was going on primarily out in Silicon Valley. People overly optimistic about what internet and technology companies can do. I personally still feel that that is one of the sectors of the economy that most of you should still consider being overweight to. Overweight being the reference to having a benchmark that you would liken your portfolio to, and then having that benchmark maybe only be something like 18% in technology, but you might be 21% in technology. I still feel that that, with a number of the managers that we favor, is the place to be for the future. But again, it's a little bit riskier. That's an area that took a big hit last year. So small investors suffered big losses when that also happened. And it wasn't just stock market losses. Our daughter was dancing for the Oakland Ballet at the time, and the Oakland Ballet folded because Silicon Valley was in trouble and couldn't support two ballet companies, both San Francisco and Oakland. So why do bubbles keep recurring? Part of it is overconfidence. Part of it is our feeling that the sky is not the limit. Short-term memories. We don't always remember the most recent bubble collapsing on us. Sometimes emotions are overriding our logic. Sometimes it's having that conversation with somebody and them telling you that they just made 32% and you made your solid and secure 3.5% and you just can't stand it any longer. You've got to just jump in and go after that 32 as well. And then the perception that a single asset class will continue to outperform. Have any of you ever seen a Callan periodic table for investments? Some of you have seen a periodic table back when you were in geology or something, but a Callan periodic table, and I don't have one in this presentation. I wish I looked for one that would come all the way through last year, and I couldn't find one. But a Callan periodic table will have probably about 12 different sectors of the stock market, whether it be small companies, mid-sized companies, international, large company growth, real estate, and usually they're showing real estate not by what we all have in our homes or condos, but what we have in investment-oriented real estate through the real estate investment trusts. Gold could even be one thing, and then of course cash. And you can find on a Callan periodic table, each of those little sectors of the economy will have a square, and it'll be a different colored square. And if you pick one color and you follow it, you're going to be like this. You know, it's going to be showing you that sometimes that particular sector of the investment world is at the highest performance level, and sometimes it's at the lowest, and sometimes it's kind of in between. And so one of the things that happens is not relying on a single asset class, and we're going to talk about that in a couple slides too. So other things that you can see from a potential dot-com bubble and is that the stock market is a common topic of conversation. I used to have one client who would come in and tell me that she just heard somebody on the bus telling her that she had to do something with her portfolio. And I thought, that's great. I'm, this anonymous person on the bus is now giving financial information. But that is what happens. We all do talk about this. One of the taboos in life is still money. People will go on a stage like this, back when Oprah was still on television, and now I don't even know who all the other daytime people are, but they'll go on one of those stages and they'll talk about the most private aspects of their life. Some terrible things that happened in their family, things that they would barely ever share with anybody, and they're sharing with millions of people out there, anonymous people in an audience. But then, you get into a conversation with a friend and they'll say, well, tell me about how your investments are going, or how much money are you living on right now? And you look in horror, like this person just asked you the most private thing in your life. We still don't share much of that. Make sure you are sharing it at least with someone. Share it hopefully with somebody you're getting advice from. For all of us in this room, I would say we should also be sharing it with our adult children. We need to make sure that they're partners in this whole venture with us, because none of us ever knows when we're not going to be able to make some of those decisions, and we want them to be aware of it. So when they've started to get stock tips from just everybody, that and the magazine covers are all talking about this new paradigm and how we're always going to be on the upswing, that's when you've got to really worry about some of these market bubbles. So I want to talk a little bit about your retirement goals. Most of you in this room, except for me maybe, are retired. Some of us are certainly, like me, nearing retirement. So we have to understand our comfort level with risk. One of the first questions I ask a new client is, where are you on a risk pyramid? If 5 is the most aggressive and 1 is the most conservative, where are you? And as common nature, I'll tell you many times, people will say, about the middle. About the middle, because after all, we all like to sort of be average, about the middle. And if it's a couple that comes in, many times you'll get them saying that one of the couple is more like a 1. I've even had some people say, I think I'm about a -1. But if some people come in and say they're about a 1, and then the other partner in the relationship is a 4, well, you're going to have a problem there. Because what you're going to have to do is try to keep both happy. And if assets are not segregated, if they're running them together as a family, then you're going to have to make sure that you're still looking at keeping both the risk taker happy with the amount of risk that's being taken, but the non-risk taker equally happy with the fact that you've got enough comfort in there with their risk as well. Creating investment goals based on the cover of the importance of how much money you're managing. You can pick up any magazine and it's going to give you one of those pie charts, right? There's a bunch of them that are going to say, so when you're in your 20s, your pie chart should be all equities. And when you're in your 30s, and then they'll have an amount, balanced between if the main categories they're using are risk and are stocks and fixed income, they'll show a little bit more fixed income coming in. And then as they move up the pyramid, they're going to start showing you an increasing amount of the cash position, the money market position even. I've seen some of those charts, and this has been in this last decade when there were times when banks were paying us 0.4% on money markets. I've seen some of those charts where they're showing as much as 40% or 50% in money market for a retiree. It makes no sense whatsoever. Now, there are other options for fixed income, not as safe as money market, not as safe as CDs, but there are other options for fixed income, one of them having been the real estate investment trusts that I mentioned earlier, one of them being some of you have annuities that have underlying guarantees of at least 3.5% or 4%. I had one client come in the other day who's got a written guarantee of 5% on an annuity for as long as she lives. I haven't seen that one in a long time. But you've got those things as an alternative to fixed income as well. But that idea of pigeonholing people by your age into a pie chart, in my world, doesn't make that much sense. I've got people in their 30s who are conservative and want to be at most probably a 50-50 kind of allocation. I've got people in their 80s who want to be 75-25. So the more important thing is to be comfortable with your own risk tolerance, and if you're partnered with somebody, that you come up with a blend for the two of you. We want to consider how diversification can help smooth market ups and downs. All of you have heard people say diversification is the most important thing you can have in your portfolios, right? Everybody talks about diversification as adding safety. To be honest, it doesn't always add safety. Late last year, the bond market was in trouble, the stock market was in trouble, real estate had kind of reached a peak. There wasn't pretty much anywhere in a safe harbor to go and pull in your boat and wait out the storm. But again, the idea of being more diversified through different sectors usually will at least expand your potential growth and minimize your potential risk. So it still has very valid concepts. And then obviously, we're always going to tell you to talk to one of us. This next chart that you see is one that shows you, and you can probably, I don't know, it's pretty small. Well, it's not too bad up on there. It's pretty small on this screen. But it's showing us a couple different things. You'll see that it's showing a 40-60, with 40% being in stocks and 60 in bonds, versus a 60-40 versus the S&P. Now, I'm talking to a group who are in the state retirement system. A bunch of you are maybe 100% in the core account. I've been around long enough that I remember when they used to call that the fixed account. It was fixed and variable, right? And then we had the 70s when the stock market was, again, experiencing a lot of volatility. And probably none of you, because you were too young and still working at that point and had many years ahead of you, but some of your predecessors who were already either on the cusp of retirement or retired were calling the legislators down at the state capitol and saying, why every time I get this statement from the state retirement is my account going down in value? And so the legislators, in their wisdom, and I use that rather facetiously, in their wisdom, closed the variable account. You all remember that? That was a whole time when you couldn't participate in the variable account. Now, you're all extraordinarily lucky that the investment board is managing your money, because the investment board knew that you couldn't be in a fixed account with all of your money for a safe retirement. And so the investment board changed the fixed account from fixed to core. And as we sit here right now, it's been a while since I've looked at the actual numbers, but my guess is it's pretty much still in roughly a 63-64% equities, 36% fixed income position. That's about where that core account usually is. It could go down as low as 50-50. I don't think they've been there in quite a while, and I don't know that they will be there in quite a while. But you also all know that if you were retired and drawing money out of the state retirement when we had the Great Recession here in 2008 until 9, that if you were in the variable account and the variable account went down 40%, your payments went down 40% too. But if you were in the core, you got 5-year smoothing. So even when the market started recovering in 2009, recovering pretty nicely as a matter of fact, and in 10, 11, 12, 13, you kept seeing smaller payments come for the rest of those years for the 5-year period. But it was a wonderful thing because it leveled, it smoothed out, hence the name 5-year smoothing, smoothed out that risk of the market for you. So you're basically the bright blue line on the graph. I couldn't get the PowerPoint to actually merge the same colors, but on the graph it's kind of the light blue line. And so you can see in the middle, when you go all the way out through October of 2018, you're right in smack dab in the middle. If you were still in an S&P 500 index fund, or your advisor like me had you and I have almost nobody that's this way, by the way, but if we had somebody who was 100% in equities, that S&P 500, that green line would be the one that we would probably be using as their placeholder. And then the opposite one, the 40-60 bonds, is the more conservative one. So you see the magic of that diversification. You see it also on the bottom chart, which shows you during this same time period of October of 2007 to October of 2018, what the return was on all these investments, REITs being the big winner. Now, REITs, of course, took it really on the chin in 2007 and 8, so a lot of that time frame was the recovery of that real estate market. But you'll also see that gold was high. Well, why was gold high? Because people flocked to gold in times of uncertainty. And coming off of the Great Recession, and it was close to being a depression, people were flocking to gold. I don't happen to be a big fancier of gold, other than the kind you can wear. But I think the purpose for gold is that it combats superinflation. And by superinflation, I mean like what we had back in the 70s, double-digit inflation. And with the current camp of people we've had in the Federal Reserve for the last 3 decades, I think that's virtually impossible to foresee that. And I don't think, and gold has been quite volatile, but you can see it has still managed to do okay. The S&P 500 would be a better placeholder for me. That would just say you would be in stocks, whether you were in an index fund or whether you were in hand-picked stocks or hand-picked mutual funds. And then you've got the 60-40. So there you are, that baby blue color. That's your core account in the state retirement. And then it goes all the way down to where inflation was, virtually non-existent during this time, a little over 2%. Last quarter, we moved up over 3%. And if oil ever starts going on a steady trajectory upward, we could be going back to 4%, as we were headed towards in 2015, when oil went from $100 a barrel down to 25. We were headed towards 4% inflation that year, because remember, oil isn't just impacting us filling our cars up with gas, it's impacting how much it costs the farmer to produce their goods, how much it costs people to produce their goods in factories, and how much it costs everybody to get their goods to market. So the oil collapse was significant in that regard. The EFI, if you aren't familiar with that language, that's Europe, Asian, Far Eastern, so that's an international index. And it's really kind of surprising that in this whole time frame, it's even up as much as 5.7. If we were just looking at the last decade, all during our recovery since the Great Recession, most of the international market has been underwater. But this does at least show you the advantages of diversification. This shows you another advantage. One of the big advantages being time. Now, you could all sit there and say, yeah, but we're retired now. We don't have time on our side anymore. We're not adding to our investments anymore. We're taking from them. For over 70, as I am, and many of you look like you might be, we're being forced to take money from our IRAs and our 403Bs and our 401Ks as well. So, but the advantage still is to know with your underlying investments that those investments are not. We're looking at the whole of your life. And I don't believe there is any one of you in this room who can tell me what that is. Some of you may think you've known that. I was just visiting a friend the other day who was telling me about the time she was diagnosed with cancer and given 6 months to live. And then she went to another doctor, gave her 6 months to live, and she said, I don't believe in prognosis. Went to a third doctor, and here she is alive 30 years later, doing just fine, thank you. So, most of us don't know what that time frame is. But given average life expectancy, we're all pretty sure that we're going to outlive maybe where our parents did. Next year would be the year, when I turned 72, would be the year my mother died. When in 6 years after that would be the year my father died. Now, I know I've done some things differently from what they did too. They were both heavy smokers. There were some other aspects of their life that were just different from what I'm trying to do with mine. And so I don't think that that's telling me that that's the genes I've inherited and that's what's going to happen for me. So I don't think most of us know what that time frame is, but what we do know is that we can probably at least go out to the 10-year period. And you'll see, if you're looking at 1-year periods, you're going to see that with the stocks, where again, the average annual return is 11.1, but with that green bar, or olive color bar, you've got the potential of making as much as 47% in a year, but also losing almost 40. But then with that, with the bond market, you've got much less risk, but also much less potential reward. And then with a 50-50 market, which is more conservative than your core of your state retirement would be, you can see you kind of balance it all out. And eventually, by the time you get over to the 10-year rolling, and certainly once you do get to the 20-year rolling averages, you don't ever lose money. Now, that doesn't mean you don't lose money on a week-to-week or day-to-day or month-to-month or year-to-year basis, but on the overall span of time, you don't lose money. So time is your friend. This is, one of the most popular questions I think I get now is, when are we going to have the next recession? And normally, again, we would have expected it by now. Recessions usually occur every 6 to 10 years, once in a while a little more frequently. You can see the gray bars are the recessions. They're kind of pale, but you've also got them on your handout. The gray bars are the recessions all the way back to 1900. And you'll see what happens to the market all during that same time. This is the S&P 500, obviously a big drop back in the Great Depression. You can see nothing compares to that drop of the Great Depression, nothing. We all may be terrified by some of the things that are going on in our world, but nothing that we've lived through compares anything at all to what some of our parents and grandparents went through. But you've got the different times when things were either going up or coming down. You see the major recessions. The last 2 recessions have been aberrations in that if you had a chart like this, and I had one that showed all the recessions from about 1945 on, as I mentioned, a lot of times by the time the recession is officially declared, the market's already been going down. The market goes down because the economy is going down. People are spending less money. People are buying less money. Already some layoffs might be occurring. And if you're still in the world of work, as a couple of you might be, or as I still am, if you're at work, and certainly if you were down on campus and you saw somebody down the hall from you got a pink slip, you're kind of wondering, when's your day coming? And we've always prided ourselves here in Madison as being pretty much inflation-proof. And by and large, we have been. But did you all notice in the Great Recession that we weren't quite as inflation-proof as we often have thought we were? There were some of our favorite restaurants that closed, and they weren't closing because they had terrible food. They had been good, thriving restaurants. There were little shops that closed. There were businesses that shuttered. And then let's talk about the big demographic change. How many of us, as we used to pore over the Sears Wish book at Christmas time and pick out the things and circle them, or fold the page down as to what we wanted to make sure that Mom and Dad would be able to tell Santa we wanted. How many of us ever thought we'd see Sears close in our lifetime? Now, when I've said that to some people have said, "Oh, I did." Yeah, they were managing terribly. So an article the other day said Sears could have been Amazon. They had that kind of access. They had the access that was access of that day, that big, huge catalog. And then the little smaller Christmas catalog, all those things, and instead they're gone. Toys R Us, gone. Boston Store, Shopko, all of these things gone. Now, a lot of that has to do with one of the massive changes, and I think most of us in this room are probably part of the baby boom generation. Remember how they used to call us the rat and the snake? Did you ever hear that? I say that to clients all the time, and I keep expecting somebody's going to tell me, yeah, I've heard that, and most people say no. I always heard it. Maybe it's because I've been in financial services since my early 20s. But the rat and the snake, and thankfully, I'll say, I've never seen a snake eat a rat, and I hope I don't ever have to. But what they tell me it looks like is there's that long, skinny snake, and you see the rat moving throughout that long, skinny body. And that was what they were likening us to, the baby boom generation. Because when we were all born, biggest birth population ever, the communities started running around and building schools, right? We need more schools. We need more schools. We've got all these kids, all these babies now, 4 or 5 years are going to be in school. All the baby products started really taking off. Then when we got to be driving age, all of a sudden a lot of families said, maybe we can't be a one-car family anymore. So auto industry took off. Then we got to go to college. That all became the big thing. Then we got to start all over again with our own families and have our babies and all the things that came out of that. And then eventually, for a lot of you, you're retired. And what are you doing with retirement other than coming here and listening to me talk? You are traveling more probably, either to see those grandchildren or in some cases maybe even great-grandchildren. If it ever warms up, you're maybe golfing more or playing tennis. You're gardening more. You're doing more reading. You're doing more leisure time activities. You're maybe eating out more. You're doing some of those things. And so now all of a sudden those things have been booming. Well, the millennial generation is bigger than us. And the Gen Z generation behind them, the kids that are still just in college or high school and getting out of high school, is bigger than them. So one of the biggest demographic changes we've got coming forward is that they don't, and this is going to sound subjective, but they don't live like we do. I mentioned Tom Plum a couple times. Tom Plum will say, I don't know what the millennials are going to buy, but I know how they're going to pay for it. They're going to use Apple Pay, Square, Venmo, debit card, their phones for any of those things. They don't have checkbooks. I know this from asking my son for a blank check out of his account so I can put some money in it for him. He doesn't have a checkbook. They don't carry cash. And they, as the chair of the Overture Board, I'll tell you, they buy their tickets really late, which drives us all very crazy. Because we think something is really not going to do well, and all of a sudden it's close to sold out. But we didn't know that, because they were just buying on the night before or the day of. So they say they're, at least at this stage of their lives, they don't want homes. That's why we're seeing apartment buildings going up all over our community. They say they don't necessarily want a car. They want to be, or some of us, can speak for myself, and I bet you for a lot of you, maybe your whole career wasn't at the University of Wisconsin, but maybe your whole career was in the same profession. Mine has been in the same profession, all in Madison, Wisconsin, so they don't want that. They may have 5, 6, 10 different careers in their lifetime. So what do? You buy what you know they're still going to need. And that's where some of these things come from. So when you look at the recessions, you can actually see, if you can tell from this, that many times when the gray bar starts, the market's already recovering. That what didn't happen, that's the pattern all the way up until 2001. In 2001, that didn't happen. In 2001, we started in the same way we always do, market going down because we were headed towards a recession, getting a little bit worse when we're in a recession, starting to recover during the recession, because that's, after all, 6 months of up movement is what signals the recession being over. So we think we're moving towards that, and then we had September 11th. Well, September 11th horrific as it was, and I don't believe our country has still recovered from it. It's still impacting our foreign policy, to this day, and probably will for forever. But it wasn't that much of an economic event. We had the airports shut down for 2 days. We had, some deliveries on truck, shut down a little bit. We had things right near Wall Street shut down, but they just moved things over to New Jersey. It really, within a month, everything was back up and operational again. People's lives were changed for forever, but it really didn't impact us too much. So then we rebounded and started having our rebound again, and then what happened? We were out of the recession, and we had a much bigger fall off. You can see it there on the chart. It comes after the gray bar. That's Enron. That's WorldCom. That's corporate scandals, where all of a sudden people are saying, yeah, I have these things called stocks in my portfolio, and now I don't know if they're even worth the paper they're printed on, because some of these people seem to be playing a lot of funny games with them. So that's a good pattern about recessions. I still don't think we're probably going to see a recession. Here we are. We're almost at the tail end of May. If we were going to see one in 2019, we'd have to be starting to book negative GNP within a month, and I don't see that happening. We, in fact, had a pretty robust first quarter. So it's just the fear of recession that we're hearing out there right now. I do think it could happen in 2020. Again, we're in the longest bull market ever, but it's not the biggest bull market ever. We haven't gained as much. It's been a more moderate bull market. And it could go on for a little bit longer. These tariffs could push us prematurely into a recession, because they're going to raise the cost of goods, people are going to spend less, manufacturers are going to be hit by that, there could be layoffs, there could be, some job closures, some shutdowns of plants, whatever. So that's the recession thing. So these last charts I'm just going to skip through, because most of you already have gone through this, but I think it's still important for you to see some of the things that we want to talk about. We want to talk about financial wellness, being spending within your means, paying down your debt, protecting yourself, being financially prepared for the unexpected, using the right information to make good financial decisions, maybe not the person on the bus, and having a plan for the future. There are 5 factors, according to a thing called the Moody survey that was done by the Whitman Insight Strategies, that talks about the 5 factors to financial wellness. The first one is something hopefully all of you have done with somebody, or you can do it now online without hiring somebody. You can find a site and do your own financial plan. I call those roadmaps. That's what they are. There's a woman colleague I have out in New Jersey who works mostly with Fortune 200 companies. So pretty high-powered people. And she works with the executives of those companies. And her average fee for her financial plan is quite a bit more than what our average fee is. And she charges no less than $15,000, and she can charge up to $20,000, $25,000, $30,000, $40,000. And as she's giving the plan to one of these executives, she says, every number in this plan is wrong. And I thought, wow, does that take guts to just charge somebody $20,000 for a plan and tell them that every number in the plan is wrong? But she's right, of course. It is wrong, because we're making presumptions that we have no way of knowing if they're all going to be accurate. We're going to use a presumption about inflation. For younger people coming in, I'm still going to use 4. We've averaged 4. If we go all the way back to the double-digit years of the 70s, and then all the virtually non-existent inflationary years of the last decade, we still average 4. For folks more our age, I'd probably say 3. I still would use something higher than where inflation is right now. Then we're going to use a growth rate on your assets. And if over the last 10 years, which has been that longest bull market in history, you've averaged on your portfolio, as some of our clients have, 12%, 13%, 14%, even a more conservative portfolio, at least 10%. We're not going to use that. That was a bull market. We're going to use something quite a bit less than that. We're going to use 7 or 8 or, 6.5, depending on exactly what the mix of assets are. And so we're going to have an inflation factor, we're going to have a growth factor on assets, and then what comes down to is one of the questions Rick told me he knew was floating around in some of your minds is, are we going to keep spending as much, or less or more going forward in the future. And my experience, 50 years worth of experience, has told me two different things. One thing is a single individual, if formerly married, now widowed or divorced, but a single individual will probably spend almost as much as the couple did together. That's been my experience. That was my experience with my father and my mother. My father outlived my mother by 7 years. He'd been the only breadwinner in the family, but he actually ended up spending a little bit more because all of a sudden he wanted to get quicker food that he could, throw in the microwave instead of mom making some of this food. He didn't want to do the stairs down to the basement to do the laundry, so the laundry was going out. Lost her Social Security. His pension stayed the same since there was no pension from her, but he actually found himself spending a little bit more money. And taxes go up, as some of you have probably discovered, when you're a single filer versus a couple filing. And at the other end of the spectrum, when I had a doctor who died very prematurely over at the Medical College of Wisconsin in his late 50s, I found the same thing happened there. There was plenty of money there. But the widow, who again was widowed far more prematurely than she ever anticipated, traveled around to see some of her 7 children and grandchildren all over the country. So travel budget had gone up. And so many times I would say, don't be convinced that one person will spend less than 2 did. Many times that will not be the case. Secondly, if in your different stages of life, will you spend less? You probably won't. It'll just be different as to what you spend it on. In the early years of retirement, we see a whole lot of people still spending money on travel, spending money on avocations, the kinds of things they still feel healthy enough to do. Later in retirement, we find them supplementing some of that, their health care expenses that are not covered by insurance, even to the point of the final year or two of life, when for many people, you're having to bring in caregivers to supplement even what the insurance will do or the facility you're living in will do. So I tell people, don't count on spending less unless you know for a fact that there's something that's in that today budget that is definitely going away. If you still had a mortgage and you know you're going to have that paid off in 3 years. If you have 2 cars and you know you're going to go down to 1. Things like that you know for a fact you're going to do. But otherwise, I wouldn't think too much about changing that. So with those very conservative kinds of things, you would project a financial plan that would be your roadmap, taking you all the way up to age 95 or 100. That's what we're showing people now. We're not showing people that with their lives ending before 95. We're assuming that for a lot of us, that's going to maybe be possible, and for some of us, it's going to be beyond that even. The forward thinking is to think more about those kinds of strategies we just talked about. Your physical health obviously is a major thing. Is life going to always be the same for you? None of us can predict that, but you certainly can do your best to control it within reason. And then your emotional well-being, and then you're all using employee benefits, you're using the state retirement system, and you're also using probably some of the medical leave that is paying for some of your insurance. You picked a great place to work, and you're doing well as a result of it. And there's so many of our clients that are like you in that regard, and it's a pleasure to do financial plans for people like you, because we typically, in a financial plan, what we always will say, and this is talking, to UW type people, it's a different version of the thing, get the red out. This isn't getting you ready to go down to the stadium. Get the red out is when you're doing a financial plan, and if you have any red, it's an unmet need. It's where your outgo is bigger than the income, and you've already exhausted some of your assets, and then there's some red that shows up in later years, usually 90, 92, 95, 98, somewhere around there. Ideally, we want to get that red out. We want to make sure that no matter how long you live, you are going to be prepared to have assets for your needs. These are some of the factors for wellness. I don't think I'm going to go through those. You can read them on your own. I thought this was an interesting chart, was how income affects the mindset. We have people in retirement who still are saving. You know, the money's coming in the door from the pension, from the mandatory required minimum distribution that they have to take, maybe from dividends off of a stock or bond portfolio. And they're still saving. They're still building up their accounts. Used to have one client, unfortunately the last of that generation. I'm now working with the daughters, but there was one couple who came to me. I worked with both his parents, I worked with both of them, and now I'm working with the daughters. And I love that multi-generational approach, because then you're making sure that the desires of one generation are at least being passed on to the other one. We don't have any guarantees they're going to follow those. We don't, you know, unless you want to try and control things from beyond the grave, you don't know that that's going to happen. But at least if you are able to transmit those ideas and let people know, I think there's some wisdom to that. But of those who are saving, you know, those who said they can't afford to save more money, and you'll see at the different income levels, there are differing percentages of those who feel they can't save. And this couple I was talking about, every time they'd come in, they'd say, now how did that bank balance get up to $100,000 again? You know, and so then they'd write a check and invest some of it. But there are people who just have more money coming in than they spend, and that's a great place to be. This is where most people's money goes, some of it for debt. A lot of you hopefully have cleared that off, or at least have the best kind of debt if you're going to have it, best kind being home-related debt. And so this would be setting a budget. If I asked, and I wouldn't do this because some people feel it's an embarrassing question, how many of you operate on a budget? Most of my clients will tell me, I don't operate on a budget, because one of the things they have to do a financial plan with us is give us a budget, because that's the lifestyle we're going to try to preserve. And so I say, well, go home and take out 3 different months from the check register, and one in the dead of winter when you're paying heat bills, one in the summer when you're traveling more, and then just an anonymous 3rd month, and average all these expenses out. That's going to be a lot closer than us using averages. Nobody else's averages, it shows your lifestyle. So when you build a budget, if you're going to do it, the most important thing is to know that you are investing according to that budget. As we showed with the time value of being invested and how you lessen the risk, the longer out you can keep that money invested. If those assets are assets that you only need some income stream from, and you're not going to have to go in there and pull big chunks of money out of, then you're going to be a whole lot easier to create a portfolio for, because we're not going to have to try to guess what's going to happen in the market. So I thought this was kind of interesting too. It shows how many people who set goals, how much better they do if they do set goals. I think that would probably be, that's why a lot of you are in this room today. And this was a chart that doesn't help a lot of you anymore, but this is a chart that you may want to take and give to a grandson or a granddaughter. I created for Lincoln when I first joined them back in '84, I guess it was. I had a couple of clients who were wanting to set up 403B plans, and they had young staff, people in their late 20s to early 30s. And they said, we really want to do a retirement plan for them, but we know they'd rather have the money. And so they said, can you do something that would show them how this is important for them? And so I created a chart called The High Cost of Procrastination. And it showed somebody at the age of 25 setting $2,000 a month, the amount you could set aside back then into an IRA, but that this firm was willing to do for their 403B as well. And that they would contribute that until I think it was age 28, up to age 35, so 7 years. So they would contribute $14,000. I showed another person not contributing in that 7 years, but then at age 35, starting to contribute and contributing for 30 years, all the way up to age of retirement. So that person contributing 30 years worth of $2,000 contributions, or $60,000. And the question asked was, who ends up with the most money? And I thought I always understood the time value of money. But after I calculated that out, I went back and I ran the calculations a second time and a third time, because it's the person that only contributed 7 years. And it was only a difference of 7 years. The person that contributed 7 years was ahead of the person that contributed for 30 years because they got an earlier start. And this wasn't based on going into the actual market at the time, so we didn't say, oh, but they hit a bull market, so that's what helped them. No, this was just looking at an average return. And so Lincoln decided to print that, and unfortunately I don't think they have it in their roster anymore, but I still have clients asking for it. Do you still have that procrastination thing? Because I'd like to show it to my son who just got a new job and really should be funding his 401k, or just want to give it to my granddaughter who just graduated and is going to have a new job and could be funding hers. So use this chart with them. It's, you are showing them, you're role modeling to them already, that you knew how to handle your own financial affairs. I'm saying that as a broad-based comment to all of you, because I'm pretty sure that that's true for all of you. But you can also show them some of these little hints once in a while. So then this is the benefit of tax-deferred savings. So that is it for the formal presentation. I think you wanted people to be able to take a little break, and then we come back for questions. I'll stay here, sip on some water, and if anybody comes up and has a personal question they just do not ask before the whole group, I'd be happy to talk to you as well, and I'll even take the microphone off so the whole group doesn't hear it.
So 10 minutes, we'll be back here at 20 after 11 for some questions.
This room, it's going to affect most of you, and it's your required minimum distributions. Do you all know how those are calculated? Some of you probably do. There's a chart. And old ancient history, is this a little too loud? Should I turn it down a little? Is it okay? Turn it down? Just a tad. And where is tad? Let's see, just a tad. Okay, is that better? All right. In the old ancient history, you know those maps when it says, it didn't adjust, did it? It's still loud. More than a tad. Can you figure out that? I do have a voice that carries. Maybe I'll try that. Okay. Is that better? Okay, let's go with that then. So in old ancient history, you know how when you pull out a road map, back before we all had Jeep, this is really ancient history. Who uses a map anymore, right? So when you pulled out one of those road maps and it'd say, okay, I want to go from Madison to Chicago. And you'd get Madison over here and Chicago up here, and you'd bring your fingers together, and when they met, that told you how many miles that was, right? Well, that's the kind of chart we used to have to use for required minimum distributions. For any of you who are couples, we'd take spouse's age and the other spouse's age, and we'd bring them together, and that would give us a factor. And then eventually the IRS said, this is ridiculous. You have to keep doing all that. We have to keep all doing all that. So what they did is they came up with a joint life expectancy table. And even for those who are single, never married, even for those who are divorced or widowed, you're still in that joint life expectancy table because they're presuming that you are going to have named somebody as a beneficiary. And unless it's a charity, whose life is expected to be infinite, they've got a life expectancy too. But we don't have to know the birth dates anymore. They just calculate this joint life expectancy table. So when we turn 70 and a half, as I did a year ago, you go to that table and it tells you your factor is 27 and a half years. So that tells me that either I or my husband or one of our kids, if something happened to both of us together, will live 27 and a half years, and that's how much money they'd make me take out. I'd take that factor and I divide it into my previous December 31st account balance. Now, if something happens to you and you're married, you can take your spouse's money and just add it to your own. But if you're the last survivor, or if you were never married, if you leave money to adult children or nieces and nephews, as some of our clients had, or other people of that sort, then you go into another table up at the top of the page, and if you've named those beneficiaries, they're called named beneficiaries then, and you pick their own birth date, and that gives you a life expectancy for them. And every year, they deduct 1 year from that life expectancy they had at the year that they inherited the account. So theirs goes down by a full year every year. Yours on the joint life expectancy does not go down. One risk I see for the required minimum distribution is that, especially after the Great Recession and the market upheaval, some people got too conservative with some of their retirement plans. And your retirement plans are going to be one of the areas where you want to stretch your risk tolerance a little bit more than you might for an after-tax account or something that you might be dipping into to give a gift, a year-end charitable gift, or a gift to children or grandchildren, or help with college for somebody. If, for example, I mentioned earlier that that this one woman who had this 5% guaranteed annuity. Well, that's a pretty great annuity, but she's already in her 80s. She's already being forced to take out more than 5%. If you go back to that joint life expectancy and you convert that joint life expectancy into what it is percentage-wise, at age 70 and a half, it's about 3.6%, 3.6, 3.7%. In your later 70s, it becomes 4%. In your 80s, it becomes 4.5, 4.75, 5%. If you live long enough, whichever one of you makes it to 110 and invites the rest of us that are still alive to your birthday, you have to draw out 50% of your account at that point in time. Then it doesn't go up anymore. Then they say, once we take 50%, we're happy. You can just give us 50% every year. And therefore, under that joint life expectancy, you'll never run out of money. There'll always be something there. Now, it's a required minimum distribution, so you can, of course, always take more. Okay? So that's one of those questions. I'll throw in a couple of the other questions when I get to them. Yes?
So if I leave some of my IRA to my daughter, would she be obligated to take RMDs?
If you left, yeah. It depends on when. If you leave your IRA to your daughter as your beneficiary, if you're older than 70 and a half and you die, yes, then she has to take them, but not based on your life expectancy. If you've named her, it's based on her life expectancy. It's in that chart up at the top where we identify her life expectancy the year of your death, and then every year she has to deduct 1 year from that. So she knows the year she inherits it. If, let's say, for like a 40-year-old, the factor might be, 25 years. Then she knows it's going to last her to age 65 if she just takes the minimum.
So it would not be taxable?
It'll be taxable.
On my death, the amount?
No, it won't be taxable on your death. It'll be taxable to her as she takes it out.
Okay, thanks.
Taxable to her. A Roth doesn't have the required minimum distributions. That's one of the magic of the Roth. I was saying to somebody else who came up and was thinking a Roth might be a great gift for some recent graduates, and I said it is. It's a marvelous gift. The Roth, you don't have to take required minimum distributions, and upon death, you pass on the same tax-free nature that you had in your lifetime. It's a great vehicle. For a lot of us, it came about a little bit too late for us to put significant money into them. Some people even wanted to look at doing Roth conversions. Right now, some people are thinking of doing Roth conversions because we are supposedly in lower tax brackets. But as many of you heard, and if you read anything on Facebook or in the media, there were a whole lot of people that said, I thought I was supposed to be having lower taxes and I seem to owe more, you know? So I think for some people it wasn't necessarily the lower taxes that we were expecting we might have.
So for regular RAs, you can convert them to Roth?
Yes, you can. The question is, for regular IRAs, can you convert them to Roth? You can. There are a couple of situations for very large income owners, producers, where you can't. But for most people, you don't reach those levels. And you can convert an IRA to a Roth, but then you pay tax at today's tax bracket. So you want to make sure you study that pretty carefully.
There's a huge number of people who have no savings. How is that going to impact us?
That's a good question. There are a huge number of people who have no savings. How is that going to impact the rest of you who do? You know, you've all heard the statistics too, that Medicare is going to be out of money in 12 years, and Social Security is going to be out of money, and and all these other kinds of things. For all of my 50 years, I've been telling my clients, I'm not a doomsday person. I don't believe that the government is going to fail to live up to those promises. You do have to understand that the promises were made under a completely different environment. When they created Social Security, when FDR created Social Security, the average life expectancy was a couple of years beyond retirement. People were dying in their late 60s. So the proposition of maybe having somebody on Social Security for 30 years or more was something nobody ever conceived of. However, it's a promise. I believe they'll hold true to it. I think there's a number of things they can do. One of the things would be to means test a few of the people. I'm not sure that, now I've lost it completely.
You're good.
Okay. I'm not sure Warren Buffett needs to collect his Social Security. I'm not sure that Donald Trump needs to collect his. So one of the things would be means testing it, and certain people in the very, very high echelons of income brackets would not, their Social Security would go back for the greater good. There's also been a lot of talk, especially with the new Congress, the new House in particular, of raising the ceiling on the high income earners, not necessarily on the base amount that goes to Social Security, but on the extra amount that goes to Medicare. And I don't think that would be at all inappropriate myself. I think that those are the people who can afford to be doing that. So I'm a believer that those things are going to be there. But again, for most of us, Social Security is not and for those who haven't done the saving that a lot of you and a lot of our clients and myself have done, leaving some of those other folks with just Social Security is probably not going to be enough either.
And they don't have pensions.
Right. There have been efforts in the past, and they've kind of fallen by the wayside in this most recent administration, but there have been efforts to encourage more participation in pensions. One of the things I'm very proud of, and this isn't an advertisement for our firm, it's just a fact of life. What a lot of these people need to hear is why that's a good thing. So besides working with a lot of our clients, several of whom are still in the room, a few came in just to say hello and said, I don't need to listen to you, I listen to you all the time, and then left, And, but anyway, one of the things that we're very proud of in our firm is that we deal with a lot of nonprofits in town. And my successor has been very open to going down and sitting across the table from somebody at Porchlight who's debating whether or not he or she is going to put in $20 a pay period into a retirement plan and then get some sort of a match from Porchlight. And he spends, 40 minutes explaining to this person why this is to their advantage and what, with average growth on that money, if they stayed for 5 years or 6 years, that could mean. And we've been told by a couple of the leaders of a few of these nonprofits that we've sort of broken their budget a little bit because he now is getting so many people participating that their match has gone higher. And they've said it with a smile, thankfully. and they should, because that's why they created the match, was to have participation. And if there are more people doing that, and if there are more people that are telling the story like that high cost of procrastination, it's not that you have to have a fortune. If you're just starting early is the most important thing. And we do participate in a lot of educational seminars for people at the other end of the spectrum who are just getting started. One of the big problems for some of those folks, and somebody came up to me with the question is, what if you're coming out of college with $500,000 of debt now? And that's one of the issues we also are going to have to do something about, because those folks, one of the reasons I ended up here, as you heard my story, is $300, and I didn't come out with debt, but that has been a great blessing to be able to be in that position. And I do think a lot of it has to do with communication, and I think that we need to get back to some of those policies of making sure we're educating everybody about the importance of saving. maybe putting off the $5 cup of coffee once in a while and putting some of that money into a Roth instead. Other questions? There was, Rick, I'm trying to think, I've got your list here somewhere. Well, we talked about will your spending change, and we talked, and then the point I hope you all got from what I was trying to say about the required minimum distributions is, if you're super conservative with that money, you're going to see your account diminish in value. Because we've got a couple clients who love this 3.5% account that Lincoln has guaranteed, and Lincoln was paying them 3.5% when the bank was paying them 0.4%, and this woman who's got 5% with another company. But even at those rates, that 3.5%, day one of your required minimum distribution, you're going to see your account go down if that's the only thing you're in. If instead that's the 25 or 30% of your fixed income piece of the pie, great. That'll give you some stability during these rockier times that we're having. But if it's everything, if you feel so shell-shocked by what you've seen happen in the marketplace, that you just feel you can't, leave that safe harbor, then you better know that your lifestyle is going to be impacted, because you will not be seeing that account stay not only not in a growth pattern, but it will be in a declining pattern, because you'll be forced to take out more money than you're earning.
The question I have, and I've heard various things about this, when you try to figure out your investment and the percentage of what goes into what, how do you handle the state pension? Do you say that it is 60-40, and that's, so when you're trying to figure out what proportion somebody's supposed to be in, you simply say, all right, your pension accounts for 60% of it?
That's a good question. The question was, how do you handle when you're trying to figure out your overall investment calculation? And that's a really important thing to do. I can't tell you how many people come to, whether it's me they come to or somebody else, and they may have the bulk of their money invested with us, or they may only have a portion of their money invested with us, or they may have all of their money invested with us. But if they don't have it all, and we're sitting there with the blinders on, looking at what they do have with us. So many times, I'll say to clients, bring me your other statements. I'm not going to try to get you to move that money. If you ever decide you want, that's fine. We'll certainly be more than happy to help you with it. But that's not the purpose of it. The purpose is to integrate it into one report, so we aren't looking with those blinders anymore. There are a couple things with regard to that. One is overlap. You may think you're broadly diversified. You've got money over at, Wells Fargo, and you know that that's mostly in bonds, and most of the money you've got with Custer Plum is in equities, and therefore we're balanced. But maybe there's still some overlap in there where we should have done things a little bit differently. With the state pension, there's a couple things that people are always surprised at. We're an industry that's very heavily regulated. And so when you're creating an account for somebody, you have to fill out all this compliance stuff. It just looks like we're just as nosy and busybodies as beyond the max, where we're asking you all the things about what's your earnings, how much money do you have invested apart from us, all these other kinds of things. I always, in that category, if you're ever doing this on your own or doing it with another advisor and they don't ask you, as I always do, I'll always say, what roughly is your monthly take on the pension? And I'll put that down as an asset. Now, it's not an asset you can go out and get in your car and drive downtown and say, I'd like my money now, please, Yeah. But if you didn't have that money, then your other money would have to be invested far differently. And so it's really important from a suitability point of view that we're looking at that money as an asset of yours, because it's an income at least for the whole of your life, if not the whole of your life and the whole of a spouse's life, and maybe even beyond that, a period certain if there were to be a common disaster. In terms of trying to look at your overall allocation, I don't put that into a portfolio analysis, because I'm not going to even have a clue as to exactly where to line up that performance. But I've had a number of clients say, well, I want to be 75-25 with you because I'm 60-40 or 65-35 30, 35 with the core account. So I'd rather have a little more risk with you, and that'll, if we figure out roughly what we think that portion of your asset base is, then we can say, well, that probably makes you 70-30. Are you comfortable with 70-30? So you can't be precise, but you can be pretty close. And of course, it's a moving target. They change it just like the mutual funds change it, but they change it very little. It's, if you've been tracking that for a number of years, you see the core doesn't change that allocation too terribly much. And I wouldn't expect them to change it much even as we head towards perhaps a little bit of a market pull down with the next recession sometime next year.
I also wanted to make a comment that when you were talking about the question about Social Security, I have an in-law relative who's a 40-something, and he is dead certain that Social Security will be gone by the time he has to retire. And I'm just wondering if the generational differences you were talking about earlier in your talk, whether that sort of kind of feeling that Social Security is a dead issue and we shouldn't count on it in the future, whether that's actually going to have an effect on changes to Social Security and Medicare that will make it more sustainable.
Well, that's a good question. I was asking if the younger folks who are just completely convinced that Social Security won't be there for them, and maybe Medicare neither, although of course now we're hearing about Medicare for all, which I also don't think is probably feasible. But nonetheless, I do believe that it will be there. I think it could be changed. Already it's been changed dramatically just in my 50 years in the profession. Used to be that my father, actually, you've heard me talk, and at least two of you mentioned that you had him for a FIA teacher. But he actually retired from teaching on disability at the age of 62 instead of 65. And so he was able to take disability for a couple of years without locking into his pension or into Social Security. And he qualified for that, and he lived to age 78. The definition of being able to be Social Security disabled now has to be that you have a condition from which you will never recover. So you were in a car accident, you're a quadriplegic, and it's never gonna be any different for you. Or you have some sort of a condition, cancer or something, from which it's expected you will not live more than 5 years. Obviously, I gave you a story about that one too, a woman who was supposed to live 6 months and instead is alive some 30 years later. But that was the definition then. My dad lived to age 78 from 62. So he obviously wouldn't meet today's expectation. He had a heart condition, and his doctor was convinced he was going to drop over on the basketball court because he was pretty vocal in his basketball games. So he qualified for disability then. Now 75% of the claims are denied. So it's much more difficult to get Social Security disability. You've all already experienced the fact that we don't necessarily get much in the way of increases in Social Security. Remember, they use the CPI versus the CPIU. Consumer Price Index versus the Consumer Price Index Urban excludes food and fuel. Where does a lot of your budget go? Food and fuel, So they're banking a little bit of that as well. But I think they are going to have to take some of these other steps. And I think once they do get serious about doing that, and maybe with this younger Congress they have now, there will be some people speaking up for their own generations and saying we need to do this as well. Or if not, don't force people to contribute to it, and instead let them put that money into a Roth, and then they won't mind so much, And there's going to have to be, and I don't think that that's the answer. I don't think pulling people out of Social Security at a time when the baby boomers are all moving into retirement is the way to go. But I do think you've got to get some of those headlines about it going away off of the front pages. And I believe with the right priorities in an administration that could happen. Yes.
Hi, I have two questions. The first one is, on your sheet, the 5 factors to financial wellness. Mm-hmm. Could you speak a little about what you're thinking of with non-medical benefits? And my second question is, what are kind of the best tips or the pitfalls to working with adult children around keeping in the loop with our finances? Because I think it's an important thing, but I'm sure you've seen wise and not so wise ways to do that.
Well, for the first question about what on the wellness chart, and they're talking about non-medical benefits, they are talking about things like if you were at the university or in some other capacity, public schools or even the city employment or state employment, and you're in the state retirement, you also would have had the ability to participate in either a 457 deferred compensation plan or a 403B plan. That's with your own money. No match came from that. And in fact, you'll remember in our previous governor to the one we currently have, those who are still employed now are having to contribute to the WRS. Although I will tell you, having been down at the Capitol protesting on your behalf a few years back, I reminded people that you were all paying into the state retirement too, because you were eligible to be getting more pay separate from your employment as a state employee, and that you opted not to because you wanted the more significant benefits. And it was a choice on your part, and so for all of a sudden to treat that benefit as something that you should be penalized for, as instead of being the compensation that you were feeling that you had made a personal choice about electing instead of more hourly pay, was wrong. And I maybe got a couple of people that believe me. But anyway, so that, that's one thing that has changed in that, but that would be those kinds of things. And actually, the sick leave policy currently still is on, isn't, you don't have to qualify for it medically, so it's not really a medical benefit. So any of those benefits. And in the world of work, we would even include things like sick days and vacation time and family leave time and all, anything that, is a actual intrinsic value to you. And let's see, your second question was?
Adult children.
Adult children. Oh, adult children, one of my favorite topics. I think, this is a very personal decision. Some people don't want their kids to know how much money they have. And yet, and again, I give you a personal example. My father always came to me for advice, except when he was electing his state retirement, and he listened instead to somebody at the public school division. And since my mom hadn't worked outside the home for the whole of their marriage, and his was the only pension, he opted for a life and 15 years certain. And at the time he did that, his health was wavering, and my mom was out still playing tennis. And a couple years later, when I discovered that, I thought, oh, Mom's going to be living with me, but it didn't go that way. Mom got her own cancer and actually predeceased him, so it all worked out just fine. But that would have been a very important decision to probably talk to somebody about. And certainly it would have maybe been a pretty important decision for him to talk with his financial planner daughter about, but he didn't, and it all still luckily worked out okay. I have clients who have included their adult children even when the adult children didn't want to be included. I'm thinking of one woman right now who, after she was widowed, and she was widowed for a fairly long time, wanted her kids to be aware of why she was buying a long-term care policy, which is actually in a life insurance chassis. It's kind of irrelevant, but why she was taking some of her investments to do that with me. And they didn't want to come in and talk about that because they didn't want to think about their mother being in long-term care. They didn't want to think about their mother dying. They didn't want to think about any of those things. And but eventually they realized they had to. And they came in, and for the last 2.5 to 3 years of her life, I dealt only with the two of the three daughters, the two that lived here in town. If I would go see their mom, it would be to go and see her socially and take her a bouquet of flowers or sit by her bedside and hold her hand and tell her everything was fine and that she had set everything up just perfectly. But they handled all the payment of all the long-term care bills and everything else. I don't know that they would have, especially given some of the emotional baggage they were going into this with losing their dad somewhat prematurely and then now fearing the loss of the second parent. I'm not sure they would have been ready for that if she hadn't pretty much pushed them into it. We get we see it all over the place. We see clients who don't want their kids to know how much money there is because, and you've heard this, you've heard Warren Buffett says, I want my kids to have enough money that they will be able to do everything they want, almost everything they want to do, but not so much that they won't have to do, that they will choose to not do anything. And that is the risk for some people of super wealth. And some people do fear that if they share their real successes with adult children, that it might be something that causes them to pull back a little bit and not be quite as aggressive with seeking their own well-being as they maybe otherwise should be. But for the most part, I have found the multi-generational approach to be so wonderful. And we encourage everybody to do it, and then it really becomes a personal decision as to whether that's a good fit for you or not. But I think that I've gone through this now. I've just gone through it in the last month with several other adult children after the passing of their mother, who was the second to die. And these youngish women, they're in their 50s, but youngish women compared to their mom, who was in her late 80s, are much better prepared for now inheriting the money that they have from their mother, because they've seen how quickly she went through a bucket load of money once she was first having home health care, then nursing home care, and then for all of 18 months hospice care. So they've also acquired long-term care, because they saw that that is what kept an inheritance for them. Neither of these women have children. And so they don't even necessarily know who will be the beneficiary of their having done this great planning, but they feel that they were given a gift of that kind of planning by their parents and grandparents, and they want to do the same, whether it's for charities or each other, that they would, right now they're naming each other as their beneficiaries. So I think it's a wonderful thing, and financial planning done as a family concept is really a blessing. It's a true blessing.
What are your thoughts on donor advisor funds?
Donor advisor, what are my thoughts on donor advisor funds? We have a lot of clients that use them. It's interesting because when I'm not doing things like this or back at my office dealing with my clients, you heard Rick say about all the boards I'm on and all these kinds of things. Some of us in the development world aren't particularly happy with donor advised funds because people can set them up and let the money just sit there and sit there and sit there and sit there, as opposed to maybe writing a check to the organization that could so desperately use it. However, they are a great planning tool. For those of you who don't understand what donor advised funds are, Fidelity is probably the one that's best known, but a lot of funds have them. There are donor advised funds you can set up where you put the money in. So let's say here we are in May of 2019, and this year you want a tax break, and so you take 10,000 or 15 or whatever, and you put it into a donor advised fund, but you haven't decided who you're going to give that to yet. You still get the deduction this year, but at some point in the future you get to say, oh, I want it to go to Overture. Ah, yeah, good choice. Or I want it to go, someplace else. I want it to go to the UW. I want it to, and you've got it. So it's a great tool. There are literally billions of dollars in donor advised funds. And when you think about, especially, if the Great Recession was hard on some of us, it was really hard on some nonprofits, because not only were people not having that extra showing up at the bottom of their checkbook register when they balanced it to say, oh yeah, I can do my usual $500 a month or my $1,000 or my $200 or whatever, but they were getting less money from places like the Community Foundation, because all those foundations were cutting back on how much they could pay out, which leads to another question Rick asked, so I'll go to that one in a minute. But they, so you were, I think they're still great. I wish that more people would understand that it could be nice to do a little bit of both. Some current gifting, and once those donor advised funds get to be as humongous as they are, start thinking about, besides, isn't it much more fun to watch some of the money you've given away being used in your lifetime? That's the same thing. I had one client I was approaching about the endowment for Overture, and he said, I'd rather see 100% of my money at work, not just 5%. That's the difference between endowment and an annual gift. And there should be a balance on all those things. What that led me to think about was one of the questions Rick asked too, is he said, what's a reasonable amount to be taking down? To be honest, to know that, since none of us does know the history, the expectancy of our lives, what is it going to take for us to make sure that there is still money there when we're 103? We used to always say, for a long time, 6% was a magic number. People said 6%. Then they pretty much knocked it down to 5%. And now they've even been knocking it down to be really safe and secure, 4% is a good level. And 4.5%, maybe if you want to, be anytime we've got clients, especially if we know the clients and their spending, and also know their age and how many more years they might be spending at this level versus at a future lower level, albeit maybe health care will change that and they might not be a lower level. We think 4.5 to 5 is still okay. So what you're thinking, if you're scoring along with me on this, then the IRS, with its required minimum distribution chart, is forcing you to take down an unhealthy level. They're forcing you to start it at below 4, but then fairly quickly get to 4, then get above 4, and then eventually get above 5, and even 6 and 7, and eventually all the way up to 50%. So, so that one of the things that you can do to offset that for you, that you're being mandated, because we've got a lot of clients who say, I don't need this money. Well, now remember, one of the things you can do with an IRA is leave some of it to charity, give some of it to charity. And especially if you're not itemizing taxes anymore, as a lot of people will not be after they limited SALT, state and local taxes, in this last tax bill, that would be a good strategy. The other thing is reinvest it. Instead of just saying, oh, this money's here, I guess I have to spend it. If you reinvest it in an after-tax account that doesn't have the RMD rule in effect, then you're making sure that you're still keeping a reasonable, and if overall you're bringing down, or if you just kind of, the way the gentleman was talking about here, if you kind of look at your overall picture and say, well, if the IRS is making me take 5.5 over here from my qualified money, but I'm only taking 2.5 over here, I'm still probably okay, right? And so kind of broader picture. Open it up and try to look at everything.
Well,
you're done with me.
We need to thank Betty for coming and speaking to us today, and we appreciate your words of advice. And again, she'll be here for a few minutes afterwards if anybody has a specific question. So let's thank you.
Good luck to all of you. Thank you.
And this is a umbrella for that rainy day, which we've had a lot.